So Ludovic Subran, it's a delight to be with you. We're not talking at the most delightful point in global economic history, but it is perhaps one of the most fascinating and open-ended. First question I'd like to ask is, are the markets underestimating just how bad this coronavirus is? And bearing in mind, you know, you've got PE ratios this side of the Atlantic in the United States of 20 plus still, some of them higher than they were a year ago. The markets break record lows and record highs, record drops, record rises. How do we see through the noise in terms of market signaling as to whether they're over optimistic about the extent of the coronavirus hit on the global economy?
It's a good question. In the beginning, I think markets were actually very much linked to epidemiological data. So we were looking at, you know, as the epidemic unfolded, markets were correcting in a very unprecedented way, to the point where confinement was priced in. And then, you know, we tested record lows, and we were in the, you know, worst equity session since 1939, you know, wider spreads in 2 decades for corporate and so forth. But what really happened is policymakers were so swift, and they took such an immense insurance policy by providing this liquidity lake when it comes to central banks, but also these direct transfers of cash for the finance ministers, and also the guarantees program, that very quickly markets rebounded. And then we were all expecting, okay, it's, you know, bear markets are not linear, and we're going to see that they're going to test the lows again. And now, when you look actually at the situation, we are at the trough, economic trough of the crisis, because of half of the world being under lockdown. But markets are pricing in a V-shaped recovery. So now they moved the attention to pricing in the afterlife. But we as economists doubt that there is such a V-shaped recovery, because we look at progressive exit of lockdown policy. We look at the world being in a below potential type of regime for 6 to 9 months, till confidence and vaccines and tests and masks are all into place. And so it's true that we have been, for the past 2 weeks, I think, expecting some type of corrections. And it looks like policymakers, at least when you look at the balance sheet of the Fed, have actually done whatever was necessary to calm down markets to the point that they look overly complacent.
So we're used to, you in particular as economists, are used to financial crashes, recessions, downturns, but this is something quite unprecedented, at least in the modern world. We don't know how to model pandemics. And it seems to me that a lot of people in the markets are just assuming this is a bit like a financial crash, and the Fed will do what it takes. And as you say, there will then be a V-shaped recovery. Is there any limit to what the Fed can do?
Well, very interestingly, I think the main difference with the financial crisis is that it's a real economic crisis. And so the central banks were the first one to act, but in a sense, it's a liquidity squeeze. It's a sudden stop crisis. And so it's very interesting to see that the heavy lifting has been done by central banks, to the point that now the question is whether these actions will actually trickle down to the real economy. And it has suddenly bought time for Treasury to work in the US with the PPP program, the Paycheck Protection Program, in Europe with the partial unemployment schemes and the public guarantee schemes. But I don't think actually that whatever the Fed is doing will mitigate the recession as much as we would like. So the recession will still be massive. Secondly, what is very important also to understand is that policymakers, especially central banks, are protecting the web and ensuring that this crisis is not infecting the financial system, but they are not replacing any type of other incentives, especially from finance ministers, but also more generally sectoral policies that will help businesses survive in this purgatory of growth that we're going to be living in for the next 6 to 9 months, without travel and transportation, without retail and leisure, but also making sure that in the, we call it a U-shaped scenario, right? Compared to what the markets are pricing, this V-shape, that in the rebound, the incentives are the right ones to restart. And this is something that the Fed will certainly be helpful in by providing the right loose monetary and financial condition, but it won't be enough. And so it's interesting to see that central banks are seen as having crossed the Rubicon several times, especially when it comes to excess debt monetization. It's something that is indeed unprecedented in the US. The fact for us European that the Fed is actually openly acting in the market, ETFs and corporate bonds, is something that is quite violating many of the principles. In Europe, you've heard about the pandemic emergency purchase program by the ECB, which is a 750 billion program to help close the spreads on countries like Italy and Spain or Portugal. So it's very interesting to see that the central banks have done a lot, but the real risk of policy mistakes for me is on the Treasury side. Windfall and deadweight effects, but also how effective will be some of the programs that have been put in place in making sure that we don't have too many jobless people and too many insolvencies. And so for me, what the central banks have done is just buy us some time to make sure that we don't run into a chain reaction and an L-shaped recovery, to stay with the alphabet, like we've seen in 2009, where it took us more than 5 years to return to pre-crisis level. Which is really what we want to avoid, because the long-lasting effect, as we know, trigger this political and social crises that in Europe costed us the 2012 European debt crisis.
Absolutely.
That you would say in some countries has cost identity politics and the sorts. Yeah.
So I want to get onto that a little bit, but just to stick on this L-shaped versus V-shaped versus U-shaped expectations for the recovery. If we are ultimately following the epidemiology, we're following the scientists here, and that's what's going to set expectations in the markets and elsewhere. Then the history shows that the most rapid time we've ever gone from a disease outbreak to a vaccine is with mumps in the 1950s, and that took 4 years. So the expectation right now is 12 to 18 months, but that would be record breaking. It's worth underlining. That would be record fast speed to get a vaccine. And even then, 12 to 18 months is a long time. So maybe you, certainly V, are inappropriate. Maybe we're talking about W's stuck together. Then we go up, we go down, we go up, we go down. There'll be relaxation of lockdowns. There'll be resumption of economic activity. Then there will be pullbacks. And that it's very hard for anybody to price that kind of, it is radically uncertain.
Yeah. No, you're totally right. And this is, I think, the most difficult exercise for us, is to actually anchor some expectation as we go along. So there is, of course, this acceptance of radical uncertainty in a way. You mentioned this, the difficulty with this crisis is also the political construct on it, especially the way policymakers are behaving is a bit irrational in many ways. Managing the R0, the so-called reproduction factor, effectively while managing the economic pressure is something that we see is triggering 50 shades of reopening, from the US to France to Germany to India. And so it's quite fascinating to also see that on top of this rational epidemiological expectation, we used to make a joke about economists and rabbi, which was you put 5 in a room and you have 6, advice. I think with epidemiologists, it's even worse, So the science is actually very torn apart when it comes to how long and how the reoccurrence of the virus will happen. For economists, it means indeed pricing in this, it's a bathtub shape, in a sense, with this period in which we won't have as much confidence as we like, which will definitely change for quite some time and test the resilience of some of these factors that are underlying the economy, especially in consumer-led economies and highly financialized and service-oriented economies like the US, the UK, and advanced economies. And your point is right, which is if you add to this the fact that we don't really know how policymakers will manage this, and some of them are taking a bit more risk when it comes to health, to take maybe less risk when it comes to economic outcomes, and some are taking stricter lockdowns and longer lockdowns. And so it creates indeed radical uncertainty to the square, because of the political factor and the policy instrumentalization of how you address this recovery, which I think is even worse. Is even worse to forecast than the actual relatively below potential economic outcome we would get, or how you would position yourself if you are long-term investors like Allianz, or what type of PE earnings you could get for some companies when you have reduced consumption or reduced border cross-border flows, etc. So there is this health and economic arbitrage, but on top of you add a layer of very politicized policy makers and political responses to the crisis, which makes it indeed quite every day, actually every night, when I go to bed, I go to bed waiting to see what President Trump will announce that I will have to include in my models the following morning here in Europe. And then when I come to Europe, the entire day, we have 27 countries that are, each of them deciding on a different path when it comes to handling the virus. And so this adds to the level of complexity. And so for us economists, it's really the proof is in the pudding, but it's all about system thinking, trying to see signal through noise, trying to test what we know on interconnection, incentives, rather than to have a classic way of looking at things, because there is no classic way of looking at things in this particular period.
Roadmap. There's no roadmap, really, is there? I mean, let's assume that we're in a position where there is a vaccine, whether it's a year from now or 3 years from now, and that the world is returning to whatever the new normal will be. What do you think that new normal will look like? Will we have much more risk aversion? Is this going to leave a mark on Homo economicus, how we behave?
I hope so. But then when I look at what's happening in China, which has been first in, first out, with all the caveats that we know, revenge shopping, for example, showed that all of the ideals that people may project and crystallize in this phase, which is we're going to rebuild a world that is more inclusive, etc., may actually be put to the test. Especially my concern is that we come out to this crisis having revealed even more the vulnerabilities that we had before the crisis, especially when it comes to political fragmentation, but also when it comes to how we manage risks in general. You mentioned risk aversion in the market. It's a big concern. I was just coming to this interview, I was making some calculation, the excess savings we're talking about because of income protection programs, precautionary savings, and the loss of volume of consumption just by the sheer lockdown and reduced confidence. We're talking about savings rate from households that could jump by 15, 20 points. And so the question is, what happens with these savings? What will people do when we come out of this crisis? Because revenge shopping can take you to such a point, but then what about investment? What about traveling? What about, will people be ready, for example, to accept taxation for global public goods like health? When I look at the responses from policymakers and elected representatives, it doesn't look like we will be able to build this type of fundamental change in the way we see capitalism. For sure, we all hope, for example, that there will be a green stimulus with the right incentives to make sure that this recovery makes us less dependent on oil prices. But at the same time, oil prices are at a record low. So it's very interesting to see that I think we will be change. There will be some scaring effects just by the sheer number of jobless people, by the number of bankruptcies we will see, by the fact that we will be without much traveling for quite some time, because we will be for sure changing our behaviors when it comes to the way we manage risk or our risk literacy in general, just knowing that there could be a risk of this sort. But then what I wonder is whether this will be something that will last or not. And I tend to think that there will be some long-term changes. For example, there is research now that shows that post-pandemics, real interest rates stay depressed for 40 years, which is twice as long as for a war and 4 times as long as for a financial crisis. This would mean that the zeronomics phase in which we were in Europe before this crisis with record low or even negative interest rate could actually be our new normal, but for good, without any opportunity to actually get back to a point where you could make money on money like we used to by indebting or at least providing cash to people in need. And so this would be actually some of the changes we will see. And maybe one last change is, of course, on the job market. A lot of conversation are about reshoring. Sovereignism or sovereignist talk is back as people talk about industrial autonomy and being less dependent on other economies. But I wonder whether we will see even more outsourcing of services as people saw that people can work from home without much of a business interruption. So I wonder what will happen to commercial real estate. I wonder what could happen to outsourcing services in the phase after the crisis, because we all see the productivity gains of home office. So all of that are actually more questions than answers, but it is really something that is a bit puzzling to think the afterlife, to think about what could be the morning after COVID, and more certainly whether this change will be happening as we speak, which is in this phase of low certainties about what will be the outcome of the virus, or whether it will all depend on how we shape the recovery collectively or not, with or without cooperation in the later phase, which is basically 2021.
Well, one of the, and I'm going to ask two quite big questions, but I know our time is sort of limited, so two final questions, but both are, are fairly large. So do as an economist, be economic, which you have been admirably so far, I should add.
Thank you.
The first is about globalization or disintegration. That there is this great, which you alluded to a moment ago, there is this great insecurity by nation states about a lack of control over their active ingredients for drugs, over their resources, for the medical supply lines. Do you see basically deglobalization being one of the longer lasting effects of the pandemic?
Before this crisis, people have been talking a lot about deglobalization as the import share of manufacturing production has been declining everywhere, So there was already some type of reshoring. Of course, everybody was stunned by how China and the Chinese consumer has actually rebounded the world in 2010. This is when basically China takes over large market shares from the world. So people have been talking about this deglobalization when it came to goods. Then came President Trump in America first, and of course, protectionism became something of everyday economic concern. We were still confident that, for example, services, digital, and finance, so capital flows, people flow, and to a certain extent also digital flow, data flows, were actually the springboard onto which globalization will continue to unfold and certainly to thrive. And it's true that this crisis actually, with border controls, but also with this renewed call for industrial autonomy, and to a certain extent also with this lesser acceptance for vulnerabilities at large, is questioning certainly for good what we will call globalization in 2021. And so for me, it is of course a big concern, because I already saw regulatory protectionism, I already saw goods protectionism. And now the question is whether these rivalries that we've seen will actually not be even exacerbated for sure, but will prevent growth to go back to pre-crisis levels. We know already, for example, that if we want to rebuild everything from scratch here, we're not talking about 1 trillion stimulus for the US. We're talking about 5 trillion needed to at least reshore and produce locally a lot of what has been produced externally and imported to the US. Can you imagine the price, the markup, the price for consumers that it will entail? So for me, for some reason, I believe that there are a lot of incantation, and we will certainly see a rethink of vulnerabilities and dependencies. But I think pragmatism will prevail, and to a certain extent, the cost of things will actually be the ultimate reason why we may still see some form of controlled or managed globalizations.
Final question is about the politics of all this. Paul Kagame, the president of Rwanda, said that he predicted that Africa wouldn't return to its pre-pandemic level of economic activity or wealth for a generation. It's the lost generation was what he was predicting. We're going to have extraordinary economic suffering in the developing world, and therefore great pressure on migration, economic migration to the north, including to Europe, fueling potentially the populism that we've seen in the last decade. Do you share that expectation?
I mean, the situation in emerging markets from a purely economic standpoint is complicated because of the lack of whatever it takes possibilities, because of lesser credibilities and lower value signatures of the institutions when it comes to their access to capital markets, but also how trustworthy are some of the central banks, or how powerful are some of the central banks, because they don't have the exorbitant privilege of the US, they don't have at least for the non-CFA countries, the strength of the euro or the currency union.
Yeah.
So it's true that the outlook looks quite bleak. And that's why there's been the need to find a locus for action. The G20 and the G7 are disappointed. The IMF and the World Bank are trying to do what they can, but it's very small compared to the needs. So I understand Paul Kagame's call to action and concerns, on in front of the wall of uncertainties that COVID-19 is for net importing, high unemployment rate, and certainly low equipped countries. I'm particularly very welcoming of the debt cancellation, of the arrears cancellation that some of the countries have provided to African countries. But at the same time, you see record high protectionism on health supplies. And so I think Kagame has to call on the international sphere to say, look, you cannot inflict this type of duress to emerging markets, especially to Africa. My personal take is a generation, I don't think so. I'm an optimistic maybe at heart, but I believe that this is something that we can overcome together. And I believe that for some reasons, there are pockets of resiliency in the emerging world, especially in Africa, just by the sheer, lesser dependence on a series of traveling flows and good flows. So of course it's hard to see now because there is this lagging indicators when it comes to the contamination spread. But I would like to think that the population being younger and social distancing being maybe not, or physical distancing maybe being less enforceable, but somehow at the same time easier because of the rural areas, etc. I tend to believe that it can be managed, but it certainly is very important now, and for leaders like Paul Kagame to go in the international arena to understand that this is everybody's problem. And that if we decide to solve the problem in some countries, then this is when the migration flows start. If you decide to forget some countries that may be economically less interesting to your interests, and this is also a message to China, which is a large creditor to some of these African countries, then you run the risk of reoccurrence of the shock and so forth. So I think the call for action is very important. I'm personally more optimistic. I think we can overcome that in 18 months, 2 years, maybe at max, everywhere, because again, it's going to be about making sure that we manage the health and economic arbitrage at the same time. And it goes for indeed African countries as well as Northern Hemisphere countries.
Right. Well, on that relatively optimistic note, particularly in today's context, thank you very much, Ludovic, for sharing all your insights.
Thank you so much, Ed.